Welcome everyone today. Thanks for coming along. We've got a slightly different format today in that we've got Stuart Hoggan, who's come along to talk to us and give the inside track about local government funding. Tell us what really happened and give some insight into what might happen in the future. Most of you, I'm sure everyone, or most of you will know Stuart from days of old when Stuart was at the department. And I think Stuart, you ran the Fair Funding Review. You were Deputy Director of Local Government Finance, so you really know how it worked. And I think before you were the last stint at the department, you were at the London Borough of Southwark, so you know it from our side of the table as well. And then before that, I think you were at the department in all its different iterations for quite a number of years, so you really know how it works. Today, so we've got Stuart starts. Stuart will do half an hour's her presentation, then I'll do 15 minutes just looking at our modelling and what that might mean for you in terms of your numbers. Then finally, Dan will do 15 minutes giving you a sneak preview of the work he's been doing on local authority accounts for 22-23, which is really interesting. That recording will be on the website tomorrow morning. The slides I'll place on the website later today.
First of all, good morning, everyone. Thanks to Adrian and Pixel and to all of you for giving me the chance to come along and talk this morning. This is a little bit nostalgic for me, as Adrian said. In my last job as a civil service, I was in local government finance, and I actually delivered 8 of the annual settlements and did lots of things alongside that, including the reform programme that we're going to talk about this morning, the capital finance system, the business rates system. So that's my track record. First of all, a couple of disclaimers. The first is that there is no special inside knowledge in what I'm going to say this morning. I've been out for 2 years, and you wouldn't expect me to draw on that anyway. The second is, of course, that no decisions have been taken on any of the things that we're going to talk about. So there is therefore no certainty in the outcome that we'll see and when we'll see it, and quite a lot of uncertainty about the picture as we'll see when we go through. Okay, so but by way of outline, this morning I thought we could talk about things in 3 sections. First of all, I'll give a brief history of local government finance reform over the past few years, just to try and explain why we've got to where we've got to. Then I'll talk about the planned reform package, which actually dates from 2018. And I'll do that in 2 sections. I'll talk about the relative needs and resources section, and then I'll talk about the business rates retention reforms that were planned. And then finally, we'll have a look at where we are now, where we might go in the future, and the sort of things that will be in ministers' minds, any set of ministers' minds following the next general election. So let's dive into the first bit then, which is, I've titled it A Brief History of Local Government Finance Reform. Before 2010, things were relatively straightforward. The whole system focused on relative needs. And we saw regular reviews of the system, sometimes even annually. But everything changed when the coalition government came in 2010, and the system moved to one based more on incentives. And the principal incentives were retaining business rates locally, and in particular the growth in business rates, or decline in some cases. And the New Homes Bonus system, which actually came in the previous year, 2012-13, with business rates retention coming in 2013-14. In order for the growth in retained business rates to be evident, ministers decided to freeze the needs assessment in 2013-14. So there was a limited review to update the system at that point, and then the needs assessment was frozen from that point onwards. And the idea behind that was it would become obvious how the growth incentive was working and how the pile of retained business rates was increasing. But there was a compromise at the heart of this, which was to say the growth couldn't be allowed to accumulate indefinitely, because it would move out of line too much with the pattern that was suggested by needs assessment. So there would be a reset of growth. So the growth would build up to a particular point, and at that point, growth would be taken back to the centre and reallocated. And the date that was given for that was 2020. That was the date given in 2013-14. We'll see shortly how that worked out in practice. So move forward to 2016-17. We had a 4-year spending review that year, and alongside that, we offered a 4-year deal for authorities. So there was 4 years forward planning of allocations. It's something that seems, frankly, incredible now. Greg Clark was the Secretary of State that year, and was the distribution approach was changed in that year. It was quite controversial, the changes that were made, and ministers were starting to wonder whether they were secure in getting it through Parliament in order for it to be agreed. Remember that all of these changes that we'll talk about are manifest in the annual settlement and are voted in Parliament. So they're not things that ministers can just impose and walk away with. They have to command a majority in Parliament. And one thing that Greg did in order to secure his majority was to say, we'll have a review of the relative needs system. Of course, what he's actually doing in that was reiterating the commitment that Eric Pickles had made earlier. But he said, we're definitely going to do this. We're going to start work on this now. So off we went and did some work. And in 2017, we published a couple of consultation papers, quite broad in scope. And in 2018, we published 2 more. And we were clear in the second set that the implementation date, the target date, was 2021, which was in line with the earlier planned reset. So it would all come together. We do a reset. The money that was generated in that would go through a brand new needs formula, and that was what we were aiming for. Then, of course, everything went a bit wrong, didn't it? The Brexit referendum led to quite a lot of turbulence in government. The pandemic followed close on the heels, and fair to say attention was elsewhere, and there were elections at unplanned times and spending reviews that were just annual rather than providing a forward look. So what we ended up with, we've had 4 one-year settlements since then, or actually arguably 6 one-year settlements, because of course the final year of the 4-year deal is by its nature a 1-year settlement. And we're set up for a further 1-year settlement in 24-25. So 6 one-year settlements. Along the way, government made a couple of commitments about the reform process, which I've put on the slide. You can see the change in wording from the first to the second in the same calendar year. By the second, it's now into the next Parliament. Okay, so let's move on and have a look at the reform package itself. I'm going to do this in two sections. I'll deal with the business rates retention reforms first. We'll deal with them quite quickly, and then we'll move on to the review of relative needs and resources, or the fair funding review as it was commonly known. So the first consultation paper had 2 overarching objectives: that authorities should have greater control over the money that was raised, and also that the system should support or promote local economic growth. And this was against a background, some of you will recall, of an original commitment to 100% business rates retention. So where we are at the moment, on average, most authorities have 50% retention. Well, we're going to move to 100%, but unfortunately the bill that would give us the powers to do that fell at the 2017 election and was never revised. So the policy aim changed, in the absence of the powers to do 100%, changed to 75%. And that was the background to this consultation paper. And the things that we looked at here were the balance of risk and reward between authorities. How much risk were you exposed to? What were the potential rewards? And ways of mitigating volatility that some authorities were experiencing. The paper is still on the web. You can go and have a look at it if you're really interested. It has the rather plaintive message: we are analysing your feedback. Even after all this time, we are analysing your feedback. So what was in the paper? Well, the first and most important thing in many ways was about growth resets, and there was a commitment to a full reset of growth in 2021. And the paper talked about ways of doing resets thereafter. So how frequently should they be done? Should they be aligned with 3-year revaluations? Should they be phased in some way? Should they be partial, so not 100%, 75%, and so forth? And then there were various other issues explored around the safety net, which was intended to cope with a shock to the system, how the levy operated. So the levy was the way that the safety net was funded in part. The tier splits for growth between upper tier county authorities and lower tier district authorities, how might that work, and various administrative changes. But the key thing to take from this was that the system was set up again for a full reset in 2021. So all of the growth would be, if you like, recovered from individual authorities and would be channeled through the new funding formula. So let's look at the new funding formula. So I'm going to do this again in 3 sections. I'm going to look on this slide at the relative needs section, then going to look at relative resources, and then going to look at transition. So as I said, consultation paper in December 2018, the main aim was to bring the system up to date, and the principles that were in mind were it should be a simpler system, it should be more transparent, so you should see why it is what you get. It should be up to date, it should be sustainable over time, it should be robust, which means it uses the best available data and it uses the best available techniques or policy rationales to justify the formulas that the data is used in, and it should be stable over time. Once again, the document's available on the web, and it says we are analysing your feedback. So let's look at what was in the formula on relative needs. And that, again, that's split into 2 areas. It's split into the demand area, which I've termed structure here, and it's split into the cost area, cost of services, which I'll talk about under area cost adjustment. So demand or structure of the formula, first of all. So the needs formula is made up of a number of different relative needs formulas, and there's a different set of formulas for upper tier services and a different set for lower tier services. So just for the avoidance of doubt, upper tier services are the services that are mentioned there, and of course are dealt with any authorities across the country that have those responsibilities. So a London borough, a metropolitan borough, a unitary authority and a county will all get an allocation under the upper tier services set of formulas. And similarly, authorities responsible for lower tier services, district councils get an allocation from the lower tier formula, but also all the unitary authorities, so the London boroughs, Mets, and unitary authorities get something from the lower tier, and the 2 are added together if you're responsible for both upper tier and lower tier. So just running through them quickly then. Adult social care. I think it was well known that there was already an existing formula which hadn't been published, but the research had been done by a mixture of academics and consultants. So that was available to go, but has not been used to this point, as far as I know. Children's social care formula, we commissioned some research on that for a new formula there. Public health, there was work underway for a new formula there. Highways maintenance, we went for a more streamlined and simplified approach to the existing one. Legacy capital finance, I think, was largely carried forward. Fire and rescue, there was thinking over a new formula. And the The foundation formula was the one that remained. So the idea there was that once you'd taken out of the large specific formulas, the areas of spending that remained were relatively uniform, and you can see that in the statistics. And so the foundation formula was based on the population of each area, with a suggestion that there might be an added element of deprivation potentially. That was something that people would raise in consultation, and we would think about in time. But it was fundamentally a population-based allocation of the residual funds that were available once all the other allocations had been made. Let's move on to the area cost adjustment. So the area cost adjustment is intended to level the playing field between the different costs that you face in different areas of the country, and it's broken down between different areas. So the first is premises costs, which of course vary across the country. Labour costs, likewise, and labour was intended to include measures of accessibility of different parts of the country. So we would use travel time to measure accessibility, and the idea there was that we would pick up issues around both sparsity and density. So the former benefiting rural authorities, and the latter benefiting more urban authorities. And then finally, the idea of a remoteness measure. Remoteness would measure the poorly functioning markets for services in the most remote areas of the country, for example, where you struggle to get a good response to competitive tendering exercise. And the ACA would apply to all of the service areas above, apart from legacy capital finance. It would be tailored to each service according to the mix of premises costs and labour costs. And actually the ACA has been used, or at least used in large part. It was used for the COVID-19 funding allocations. The remoteness element wasn't included, but all the other elements were included. And then there were two final areas. When you've got your upper tier group, you need to decide how much funding you're going to put into each tier and into each service within the tier. And the idea was that would probably be done by net current expenditure. So just a measure of the amount of money that you were spending in each area at the moment for the services in relative terms. And then within each formula, it would need to be a weighting of the different cost drivers in the formula. And as a general rule, we'd use the best available statistical techniques to do that. So that's the first bit of the approach to the fair funding review. The second bit, which is on the next slide, the next two bits rather, is relative resources and transitional arrangements. So relative resources is the money that you have available to fund the services in your area. Obviously, all authorities are of different sizes, and some authorities are more prosperous than others, and so raise relatively more in council tax. And the idea of a resources adjustment is to level the playing field between different authorities by taking a measure of the money available to fund services locally. And there was two important principles in doing this. The first is that there would be no redirection or redistribution of actual money. So the council tax raised in an area would stay in that area. And the second was that there would be no reward or penalisation of local discretion. So if you had taken a serious decisions that your council tax was low compared to other areas, you wouldn't benefit from that by being given more grant than you would otherwise have got. Similarly, if you had taken decisions that meant your council tax was relatively high, you wouldn't be penalised for that. The distribution approach to distributing the grant would take a more uniform or neutral approach to that. I've talked about council tax so far. We also floated the idea of taking account of sales fees and charges, and there's quite a long discussion about that. no decisions taken, of course, but that would add further complexity to the system were we to take it would be the kind of excess sales fees and charges, quite a hard thing to measure in any case. So most of the discussion focused on council tax equalisation, and I've written down there the elements that are in the kind of the resources available, and they're in 4 different bits. The first is the council tax base, so that's the measure of the bandy equivalent dwellings that you've got in each area, adjusted for certain discounts and exemptions at the margin. The second is a measure of the notional council tax that's available. So that effectively controls the level of equalisation that you have. In other words, whether you're fully adjusting for the changes or whether you're adjusting only in part. The usual thing is to adjust only in part. So we have incomplete equalisation in most of the approaches in previous reviews and in other areas, and you control that by talking about the level of the notional council tax, or just the level of equalisation of the council tax base. And then you make an assumption on council tax collection rate. Probably assume it's uniform everywhere. So that's not neutral, of course. If areas have better rates, they do better. If they have poorer rates, they do less well. And then, of course, you have to split the equalisation between the tiers where there's more than one tier. So that's the relative resources side. And then the third thing you do is you're starting to get the answer for all authorities at this stage. And you almost certainly have to do transitional arrangements. You'll find that authorities are quite far from their current position, and you have to transition from current to future. And the kind of thinking behind that was that it was a self-funding mechanism. So winners would probably pay for losers, but you would unwind this as soon as practicable. And what you're doing there is you're trading off in time the efficiency of the distribution that you've come up with. That's your, if you like, your perfect distribution, versus stability for authorities over time, so that there isn't a cliff edge change for individual authorities. And there's also obviously an equity issue in there as well, if you can move quickly for people to get the gains that those authorities should see under the system. Okay, final slide then. So I've talked about how we got to where we got to. I've talked about what was in the 2 consultation papers and the ideas that were floating around. As I said, it all drew to a halt at that point, and government has said they'll return to it after the next general election. And I'm sure that's the case for any colour of administration. So let's look a little bit about what that might mean and what ideas are in play. Let's think about timing first of all. Earliest an election could be, I think this is entirely speculation, but let's say in the spring next year, is really too late to make changes for the year 25-26. So although that is the first full financial year after the earliest election, if that was in May, say, there's too much to do for ministers to arrive, to get their minds around the issue, to consult probably twice before having a provisional settlement and a final settlement. So that suggests that the earliest you could probably do it is 26, 27. And of course, it could be even later if the process is perhaps takes a completely different approach from what we've talked about this morning, and needs a complete rethink. Once you've got your emerging results, you're going to want to step back from the process and look at it through a number of different policy perspectives. So I've jotted down 3 here, but of course an incoming government might have a completely different view on the matter. The first is the balance between needs and incentives. So we said at the start, the original system was entirely needs-based. We now have a system that's more blended between needs and incentives. You could change that in the future. You could go back to more needs-based. You could give more emphasis to an incentive-based system, and that would be one consideration. Another that's very germane at the moment is leveling up. So you'd be looking at your numbers to be able to be sure you could defend them in terms of a leveling up policy. And you need to be clear what outcomes you expected from that policy, and then assess the system against that. A third perspective that's quite interesting is one of financial resilience. So if you were able to measure the financial resilience of the sector as a whole and individual authorities, then you could take a view on different options for reform, whether they were more or less likely to place a number of authorities in financial jeopardy. And as a general rule here, excuse me, the more emphasis you put on relative needs, provided it's measured well, the more financially resilient the system will be, because you're using the money in the most efficient way to give as much as you can to each individual authority according to their needs. And then there are various lenses that you can look through the system to take a view on. So there's the traditional classes of authorities. That's how authorities organize themselves to lobby. Departments will be very interested, government departments, in the outcome for the services that they look after. The regional split is critical, particularly from a levelling up perspective. Ministers will be very interested in outlying authorities. If there's particular authorities that do very well, or even more seriously do very badly, why do they do badly? Is that sustainable? And then there's the issue of the kind of rate of change over the transition. And it's helpful in this if you've got a forward trajectory of a spending review over a number of years, and then you can track that change. But at the end of the day, what's really important for you is who wins and who loses. And I'm going to advance the suggestion that it's almost impossible to know at the moment. Now, Adrian and Dan will make the best set of assumptions that they can, and I know they are very plausible assumptions, and they will give you an outcome. But let's think about what lies underneath that just for a moment. You've got a set of needs reforms which will tend to move money to the authorities with higher needs, or rather whose needs have changed since the last time you looked at the system. You've also got a set of resources of reforms which will tend to move to the money away from the authorities that have gained significant council tax, so have grown in the intervening period. You've got a reset of business rates growth, which will tend to move money away from the authorities that have accumulated lots of money over that period. The idea, I think, would be that negative RSG was wiped away by these new reforms, because you've got a completely clean sheet of paper. Authorities that have negative RSG allocations are the ones that did relatively badly out of the last distribution change in 2016. And none of these areas are closely correlated with each other. You've got 4 or 5 big bits of machinery all moving in different ways. And then, of course, you've got the issue of what decisions ministers take. You know, there are real decisions to be taken within this, and changes of emphasis. And, you know, we don't know at this stage where they'll come down. Even once you've done all that, if you look inside a group of authorities, let's say counties or Mets, you will find a substantial variation in outcome. So even if you thought you had let's say a good outcome across the country as a whole, you'll still see authorities in groups of that they organize themselves in, where there are significant winners and significant losers, and those ranges overlap with one another. I would suggest is quite likely. And then the final confounding fact is that when you talk about who wins and who loses, what you're really talking about is a comparison with where you are now with where you would be in the future. And where you are now is, I'm afraid, the result of a fairly long sequence of decisions taken for good reasons at the time, which may have put your authority in a relatively strange position. Correcting that will be can be quite challenging. And along the way, of course, you've got a whole set of legal, practical, and political risks to navigate. So this is not straightforward stuff for any government. I think what you see is, therefore, is at the moment you see a coalition, no coalition for change, but lots of opposition, and people are naturally conservative, which is why we've had these kind of one-year rollover settlements. It's easier to stick rather than twist. Just as a sideline. It's also problematic if you decide to implement a partial package, to do one bit of it and not to do another bit, because of course authorities can conjecture that they would gain from the bit that you didn't do, because we've kind of put forward, if you like, the Rolls-Royce package, the full Monty. If you don't do, say, the reset, then there's a whole bunch of authorities saying, well, you should have done the reset. You promised to do it before. You should have done it, and I would gain if you didn't do it, and that's quite a hard position to defend. So through all this, ministers need to come up with a package of support which is defensible in public policy terms and in terms of their own political priorities, but commands a majority in Parliament to get the vote through. And of course, Parliament, I think we've seen, is less well behaved on the government benches than it is in the past. MPs feel more independent now than they did, so that's difficult. They need support in the sector, and as we've seen, there's a wide variety of potential outcomes there as well. So, drawing to a close, why does this matter? Well, fundamentally, you've got issues around equity and the misallocation of public resources, I think. You're not using public resources in the best way that you can. But of course, at this stage, we can't say who benefits from that. There's also risks of financial resilience because you're not providing as much money, perhaps, to authorities that are potentially struggling. And there's a kind of bigger picture here, isn't there? Financial reform is only a part of the picture, and it's the only one we've had time to talk about this morning. But there is surely a bigger picture here for a government with a strategic plan for local government as a whole. And I'll leave you with the thought that it's not long to the next election, but there is surely an opportunity here for the sector to take the initiative on that and influence the main parties about what it is you want to see, not just on funding reform, but more generally on local government policy. Thanks very much.
That's great. Thank you very much, Stuart. That was absolutely fantastic. Some really, really terrific insights into what's happened. And I think as well, some of the lighter points you're making about some of the lenses that you might look at things are really interesting. So I think for us to take away and think about what that means. I mean, I've spent a lot of time looking at that last consultation paper that you did, and it is interesting. And one of the things that I have always thought about that consultation paper was that it was very full. There was a lot in it. It was a very comprehensive piece of work, and in some ways, it feels like it's ready, almost like off the peg, ready to go in some ways. Lots of elements of that I think could be implemented, I guess, pretty quickly. I think the thing that's harder, as you were just saying there, is that you've got all these lenses to look at it through. But is it a partial package? Is it a full package? What the outliers look like. And I think financial resilience in particular is one that is becoming more and more important. And I think we'll see from some of Dan's slides about whether reserves are starting to look a bit shakier than they were. I mean, what we've done at Pixel is, when that consultation paper came out in December, we tried to model it with the expectation that fairly shortly that would be something that would be implemented. So what we tried to do then is to keep that going and update it with new data and new information as it's come along, so that at least people could get an idea of the things that ministers were talking about and consulting on in 2018. If they happened, what might that look like? Just to get an idea of that. So the latest version of that model's on the on our website with a kind of a briefing note to talk about it. But I think there's not an awful lot that's happened since then that we could add to that. I think the main thing probably is that University of Kent research that you mentioned, Stuart, the social care research. we've modelled that, and that's in our model as well now, as is some of the public health stuff. But since then, the main updates that we've made are things around population and council tax, just because we're now assuming that the latest data set of each of those are things that will be included in the future funding model. Yeah. So in terms of using the model, I mean, a massive disclaimer in that it provides our best estimate, or a best estimate, of what might happen had that consultation paper been implemented in some form. But I think the key thing is that it identifies the key variables so that you can see the potential range of outcomes, but also the variables that are most important to you as an authority, and just emphasising that, you know, that uncertainty that Stuart's really talked about, but just to get an idea about if that was the package that was implemented, what would that look like? You can look through those key assumptions in the national assumptions tab on that model. From my point of view, council tax equalisation is the most important issue. Stuart's talked about that quite a bit. You know, is it full or partial equalisation? And for those of you with very high tax bases, that's an enormous issue, the most important issue as far as I can see. And that really does redistribute funding right the way across the sector. The population data sets will be important. A previous version of our model updated for the 21 census, but it's much more likely that a future funding regime would use later population projections. We've started to include what are called these admin-based population estimates for 22. They look like they're the ones that the ONS might use in the future as population estimates and population projections. And they've got the added advantage that even though they're not the official basis for population estimates, they're out before the usual mid-year estimate. So they give you more of an early warning as to what might happen. Council tax data updating for tax base and Band D. We've got some options there. You can see what happens with when you update the council tax data each year. And the key thing for those two things is that it gives, by updating and looking at the different variables, it gives you an idea about what the effect is of updating population, what the effect is of updating council tax data on your share of funding. There are some other really important elements around the size of the service blocks and the tier split on Band D, both of which are really important factors. I wouldn't suggest that you mess around with them particularly because they can get quite messy, but they are elements that we can vary as we get as and when we will get more information from the department about how they go about setting those two elements. And then finally, deprivation. Most of the deprivation funding is from the social care formulas and the public health formulas, but as Stuart mentioned, within the foundation formula, there was an indication that higher levels of deprivation might be used. I'm guessing that if now that levelling up is more of an issue, that higher levels of deprivation funding would be applied within the foundation formula. Now, these are the outcomes from the latest iteration of our fair funding model. And as you can see here, there are some big movements of resources expressed in core spending power terms based on our modelling, which is based on that consultation paper. Now you might say, well, and I think Stuart probably would say to me that they're big movements, and actually ministers would, you know, being more conservative kind of beings would be very worried at that level of change. But this is just us in a very straightforward way, just applying what's in that consultation paper, and these are the results. A couple of things to mention. One is that the baseline is really important. So the starting position is really important. So most of the 2013-14 damping is still in people's SFA allocations. There's the negative RSG issue, which is, again, as Stuart said, will be wiped away probably when the new fair funding review is implemented. And then there's the 16-17 cuts distribution. That latter issue is one that we don't particularly adjust for, but it's just worth bearing in mind that you could argue that some authorities were, in quotes, overcut during that 4-year settlement period. And again, that would be wiped out with the new fair funding review. Our modelling suggests a big transfer of resources away from inner London. So for most London boroughs, that's a combination of losing lots of those London-specific indicators, density, additional population, and also falling population relative to 13-14, the last time that population was updated. That's not every London borough, but as we'll see, it's some in particular. And then gains for lots of metropolitan authorities and other classes of authority that have got similar characteristics. And lots of the gains there are from council tax equalisation rather than necessarily from a higher share of the needs block. And other similar types of authority are in unitary authorities and also in parts of Outer London as well. Other types of authority where those classes, the outliers in those classes are losing, it's largely because they're losing from council tax equalisation. They're relatively low need, relatively high tax base. Then just to pull out some of the outliers that we've got from the modelling, and you can see your own authorities figures from the model if you have a look at it. Starting with Westminster, so a classic central London borough that's losing quite heavily from the formula. You can see there that simply by removing the damping from 1314, the authority would lose about £20 million. We're then estimating that there will be a further loss of about £98 million from the formula changes. So things like replacing density with travel time indicators and removing the additional population indicator. For Westminster, some of those losses are offset by a better area cost adjustment, particularly because it's an individual authority, ACA rather than a sub-regional one, and also it's losing quite significantly from the latest population estimates. So you can see there from that waterfall chart just how the different elements of change within our modelling suggest that Westminster might lose quite heavily from any formula based on that 2018 consultation paper. Then if we look at Surrey County Council, this is kind of a classic high tax base, lower need Shire County Council. It's you could, again, I'm going to put some quotes, gaining from negative RSG. Its SFA is just over £17 million higher than it should be based on the underlying needs assessment. It's also gaining from the damping from 1314 still being in the system as well. So its starting point is, over £50 million greater than its actual headline SFA for the current year. We then estimate it would lose from lots of the formula changes, particularly driven by council tax equalisation. In fact, almost entirely driven by council tax equalisation, and then losing again on population and the Band D updates and tax base updates as well. So again, different from Westminster, but again, this type of authority tending to lose quite heavily from the changes that are in our model. And then finally, looking at Barnsley, a metropolitan authority, typical of these types of authorities that are gaining pretty strongly from the proposals that were in the Fair Funding Review. Barnsley gains from pretty much all the major elements of change within the Fair Funding Review, certainly based on this chart here. It gains from removing the damping in 1314. So what that means is that without the damping, Barnsley's SFA will be about £2.2 million higher. It gains from most of the formula changes, particularly from council tax equalisation, but it doesn't necessarily mean that it gains from every single individual formula change. I think we saw a few years ago that some of the adult social care proposals from the University of Kent actually don't work that well for many metropolitan authorities, but overall the package is good for most metropolitan districts. And as I said, it's typical for many Mets, as well as for unitaries and Outer London boroughs that have got similar characteristics. A few biggish issues as well to think about. I think the children's services one is clearly going to be important. As Stuart said, that research was commissioned before the pandemic, but we don't know what it's going to look like. It's a big service area, it's a growing service cost as well, and that could make a big difference to funding distribution. There was some indication that work had begun or was beginning on the fire formula, but we haven't seen anything yet, potentially also with the police formula, slightly outside our area now, but I think that's probably something to keep an eye on. And then finally for me, just making you aware that our modelling on the Fair Funding Review is integrated with our MTFP model, so that brings everything together in that MTFP model. It looks at the Fair Funding Review, the business rates changes, the damping, so it pulls together what that package might look like, all those different moving parts that Stuart talked about. And as he said, fair funding is only one element of reform alongside that business rate reset, alongside the specific grants, as well as also other transfers into SFA. What's also really important is that council tax is now a much more important element within the funding package than it was in 1314. Transitional support or damping, again, as Stuart said, is really important. There wasn't that much indication within any of the consultation papers about how that would work, other than that it would be phased out as fast as was practicable. We modelled it on the basis that it's based on total resources rather than just the fair funding review, and our default setting is that it's set at 5% of total resources. But there's also a commitment that no authority would have negative SFA or negative RSG, which the longer this is left, to be honest, the harder that is to achieve, or rather, the more strings and levers have to be pulled to make sure that it can be achieved. So just emphasising it's a package of changes that, as Stuart said, will need support in Parliament and in the sector. We'll discuss this in more detail on Wednesday the 28th of June, and I will make those reservations live from tomorrow morning, so you can reserve a place on that, and I'll send out an email to let you know I've done that, and the update to our model will be available pretty shortly. And again, as soon as that's available, I will let you know. Okay, Dan, over to you. Oh, Dan, you're muted. Okay.
Is that better? Can everyone hear me?
I can hear you now. Yeah.
Morning, everybody. Thanks, Adrian. So I've just got 10 minutes in which I'll shoot through some of the accounts analysis. I'm just going to put in the chat a link to a free seminar that we're running. Sorry, I seem to have been muted for a bit. I'm just putting in the chat a link to a free seminar that we're running next week, where we'll have a really good dig into them. But for today, we'll just canter through them, if that's okay. And I think I'll make some tentative conclusions about what both Stuart and Adrian have talked about, and can we see any of the funding ramifications starting to show in the accounts and in financial health? I think we can. I've got to be a bit careful with making those conclusions. We need to do some more work, but I think you can start some authorities climbing away from financial health issues because of some of the decisions made in fair funding. But if we race through, Adrian, if you can nip to the next slide. That's just same as I put in the seminar in the chat there. Sorry, that's our session next Thursday. So starting with the accounts published, this is really interesting. I don't know what I was expecting. I don't know what you guys were expecting, but actually on the day, by the deadline, the 31st of May deadline, 30% of authorities, 3 in 10, had published their accounts. And you can see there the distribution, counties doing slightly better. But if we move on one slide as well, I've also done that by region. And actually, sorry, you can go back one. Yeah, so there are a number of issues, and it says to me that actually this does pare back to auditor issues potentially, because actually if twice as many in the East Midlands have managed to get their accounts out than have in London, then it must be backlog issues rather than technical issues, else there would be similar amounts. So differential amounts, but no regions yet reached half accounts published, which speaks to a bit of chaos in the audit field, which I'm sure you're all aware of. If we move on, another one. So 205 haven't published, and I've had a lovely couple of hours going through the delay in publication notices, and most of them point to often a combination of factors, but the delay in the 21-22 audit process is the most used factor for not publishing 22-23, and that's really logical. If you're still waiting for balances to be agreed and signed off for 21-22 by your auditor, you not necessarily want to bring them forward to 22-23, although some have. Infrastructure asset valuation is still quite big, but this year the triennial pension valuations rears its head quite a bit, and then in one or two authorities they talk about finance team resource issues, and also the bringing forward by 2 months of the deadline being a bit of a shock to some. And looking at the notes, some will publish over the next few weeks, some more in July, but actually the majority is saying when reasonably practicable. And that to me says, you know, audit issues, valuation issues, pension issues are largely outside their control. So I fear that we'll be waiting a long time for a lot of accounts and I put that down to the audit regime as it is. But let's look, because it is a delay, let's have a quick look at 21-22. If we move on, we're still only 1 in 5 of 21-22 accounts audited. 1 in 8 haven't yet published, and then the majority sit in that draft stage, and that the majority of those haven't published this year. Not a good situation, particularly when there's stress in the system, and actually all of the 114 authorities are now 2 or 3 years behind, and some of the authorities that you often read about are also, for instance, they're 2 years behind on their accounts. So at a time when you'd want to know a little bit more about resilience, we can't see it because we're stuck behind audit issues. And just as a bit of a footnote, if you move on to one slide, Adrian, you've got Wales and Scotland there. Sorry. You've got Wales and Scotland there. Now, I declare an interest here. I was an Audit Commission trainee. That's how I did my SIPFA. But actually, it seems like Audit Scotland and Audit Wales are the Audit Commission versions for those authorities, and every single set of accounts in Scotland and Wales is published, and only 3 Welsh accounts are awaiting opinion. All of Scotland is signed off. 19 out of 22 Welsh authorities signed off. So this is an English problem, and it makes me think. I'm guessing here, and others will know better. But all these things about the Financial Reporting Council and the code, etc. Either it's not applying in Scotland or Wales, or actually is something to do with the English setup that is that we're way behind. So I'll leave that there. Others will know a bit more. Others might have a view on that. If we move on to look at some of what the accounts are saying. So the MHCLGs really focus on reserves. They've recently issued some information on reserves, quite complete bits of information. But for me, it's still RA-RO forms, and for me, RA and RO forms are at best inconsistent and at worst inaccurate. I'd be nervous about those returns, partly because not everybody fills them out, and partly because not everybody fills them out particularly consistently. I think the accounts are better. MHCLG, though, rightly are looking at reserves because they have gone up significantly in the last couple of years, but they do admit to being baffled by them. But they're still also saying that some authorities should use reserves to balance budgets over the next few years. And I think what we're about to see is that that's a fairly tricky assertion to make. So based on the 109 set of accounts that are now, if you just take reserves from the MERS, exclude HRA, exclude school balances for the upper tier, take general fund balances and earmark reserves, you have an 11% decrease this year. If you then remove those reserves in 21-22 that relate to the COVID grants, the business rate relief grants, it's a 4% reduction. But these are averages. There's some authorities where reserves tend to still go up, and there's some where they have fallen really, really dramatically, probably more dramatically than in any other year. So for me, for some authorities, for the sector as a whole, I think there's a cause for concern. For some authorities, real cause for concern. And I tentatively make the conclusion that you can start to see some of the impacts of the fair or unfair funding system as is emerge in financial health. So if we move very quickly to, I think it's a graph of what I've just shown you. So that's the reserves position, and the bold line is unadjusted. It's what's come from the MERS and the EMAT reserves notes. The dotted line makes an adjustment for COVID business rate release, which really weren't ever ours, were they? They were amounts that were in reserves at the end of the year to settle collection fund adjustment accounts because of the timing differences to do with all the government reliefs on that were COVID. But looking at both of those patterns, more exaggerated, and this is my fear that MHCLG have taken the bold line and said, look, they've gone up significantly, and that's right. But even on the dotted line, reserves had gone up until last year, and now they're starting to come down. When we talk about this next week, we'll have a really good look at this and look at it by sector. And and try to make some conclusions there. There are massive variations within authorities, as I said earlier, some where reserves are still going up. And if you go on to the next slide, I've done that by, so this is adjusted usable revenue reserves. A couple of things there. Districts have much higher levels of reserves. That's down to a number of things. The business rates relief and new homes bonuses tend to be more generous to districts, but also districts are much more susceptible to changes. They were to COVID before the fees and charges came in. The reserves are wiped out much more quickly in districts, and what you see is evidence of districts collecting some of those business rate reliefs and leaving them in reserves, anticipating a reset, as was talked about earlier, and anticipating some of the changes. But actually what you see in terms of the changes, some really interesting things. Shire counties, from those that I should stress, from those that are published so far, which is only a third, reserves tending to go up in Outer London, unitaries and Mets particularly. They're coming down quite sharply. And I do wonder if there's a link to funding there, not exclusively, but a number of Shire counties, as Adrian talked about, including Surrey, have really bloated tax bases, big tax bases, and the lack of equalisation has seen them do relatively well, not well, but relatively well from funding changes. And actually, counties always had the lowest level of reserves, but they've caught up almost over the last few years. And I wonder if some of that is to do with a relatively better deal from the last 11 years since the formulae were frozen. Moving on very quickly, Adrian. So capital health, much less well understood than reserves, which are dead easy to understand. But if you look at Thurrock, you look at Croydon, Slough and Woking, they've all become undone by overwhelming levels of debt and the ability to service those debt. So we're doing even more modelling on how capital health and balance sheet health generally impacts upon the overall financial health of the authority, looking much more at the CIPFA FM code as well. If we move on, just a few conclusions from capital health. That's the CIPFA FM code, by the way. It just, to my mind, duplicates your AGS process. All those grey areas you look at in your AGS, but what it does do is it places a much greater emphasis on financial resilience over and above what you would have done in the AGS. And I think that's really important. I'd like to see the CIPFA FM code. I'd like them to firm up what they're doing with it, because it came out in a blaze of glory 2 years ago and it seems to have disappeared to some extent, but it seems to be coming back now, and so it should, because resilience is such a big thing. If we move on, so capital health very quickly. Borrowing has increased steadily across local government over the last year, nothing massive, but steadily increased. But debt gearing, i.e. the proportion of debt versus equity, has been reasonably stable, except in Outer London, where it's increasing quite significantly. 3 of the Outer London boroughs are massively investing. And I again relating it back to what I said earlier, I wonder if some of that is because some of the population moving from being pushed out into the Outer London, there's more of a housing crisis there. Lots of Outer London authorities are doing big work on housing. The problem they've got, they would have done this when interest rates were less than a percentage point. 2 years on, they're now at 5%, and I suspect that big amount of investment with cost overruns and the cost of borrowing going up significantly is going to impact upon their financial health. Interestingly, though, interest rates, I thought going up, I'd see interest payable going up significantly, because the nature of interest is borrowing in local government tends to be fixed PWLB. It's not going up at the moment, but actually Treasury income has gone up significantly in the last year. So local government seems to have benefited, if anything, from interest rate rises. I'm not sure that will persist as people have to borrow more going forward. And as another observation is that internal borrowing seems to be topping out. And if internal borrowing reduces, as resources reduce, and that has to be externalised, it now is externalised at 5%, whereas 18 months ago you'd have externalised at 1%. Just move on very quickly, Adrian. I've got a quick graph there which shows the capital financing requirements as a proportion of net revenue expenditure. Look at all of this in a lot more detail next week. and that has gone up. That's pretty much steady, except in outer London, the 4 outer London boroughs, where it's climbing quite significantly. So a lot more in outer London weighing into borrowing to do things that like regeneration and housing, but nonetheless, one might be a bit concerned as to whether economic conditions have changed to make that a little bit harder than it once was. And if we move on to what I think is the final slide, yeah, it's another plug for a session next week, next Thursday, 10 a.m. Everybody's welcome, free to come, and we'll have a proper deeper dive into these statistics. And that's it. Thank you very much. Sorry, run over a little bit there, Adrian.
That's great. Thanks for that, Dan. That's brilliant. Thanks, Stuart, as well. I mean, we'll leave the presentations there. So I mean, I know some of you will have to leave at this point, but now we'll go into more general discussion for another half an hour. So if you want to either put your hand up or just put a question in the chat, and we'll try and deal with it and get an answer to you. Is anyone going first? I mean, I had Stuart, I think if he's still there. I mean, I had a couple of questions. The first one really for me was just, I suppose more of a comment really. It was good to hear you being quite so clear about 25-26 being a difficult year, even if there's a spring election. I'd kind of been hedging my bets and thinking, oh, a spring election, it's possible they could hit 25-26, but if you're saying that's pretty much impossible, then, you know, I might look at my model again.
Well, I think it depends on two things. First of all, how ambitious you are about the package of reforms. If a government came in and it knew exactly what it wanted to do, and it was a relatively straightforward package, then it could clearly do something. And it might decide to do something anyway, even independent of a larger package of reforms. And the second thing it depends on is your appetite for risk. Yeah. So, you know, there's a lot of players in this and a lot of potential for judicial review, put bluntly. And so, you know, the system that we would design would tend to consult generally on some policy ideas, and then run a consultation on specific numbers. And then you probably have your traditional short provisional settlement consultation. But the idea there is that if it's a short consultation over the Christmas periods, you don't want to be introducing brave new ideas. Yes. And you don't want to be making significant changes in the numbers that authorities are working on. Your ideal provisional settlement is if it's a short consultation, is one that basically doesn't change. And for that, you have to make the proper preparations beforehand. Yeah. So, you know, all things are possible, and it does, as I say, depend on the level of risk that you're prepared to run. But for something as fundamental and complicated as this, if you're being in any way ambitious, I would think that it's very, very hard to fit that in the time.
Yeah, no, that's a good point, Stuart. I mean, I think I'm getting more and more minded now that I think we'll shift. I mean, at the moment, our assumption in the modelling is that those reforms happen in 25-26, just because Minister said it won't happen in this Parliament, but you kind of think a lot of work was done and it could be implemented. And I know a lot of authorities in their modelling, their forecasting are thinking, well, it's 26-27. So I think we may go that as well.
Ministers, you know, as a general rule, don't tend to don't tend to rely on the judgments of their predecessors, and rightly so, because they're the people standing up in Parliament. You know, so
they'll take the fall for it.
Well, you know, so and so thought it was a good idea. So they always, in my experience, in any colour of administration, go back to the drawing board and say, what do we want to do here?
Yeah, that makes sense. Lisa, I think you had your hand up next.
Thank you. So kind of questions and comments, if that's all right. I mean, and as a tiny district, I am very aware that our numbers are quite insignificant compared to the unitaries and counties, but nonetheless, still really relatively for us is still a big deal. And we are one of those that that have benefited significantly from growth from business rates, and we will go bankrupt if there is a cliff edge, which accepting there won't be, but even so our growth is so big relative to our kind of baseline position that I'm really concerned about the transition period. So how likely is it that it will be I don't know, sustainable for us without having, because the planning for this is really tricky, because if we were planning for what actually is in your model, Adrian, I'd have to issue a section 114 because it's millions, and that coupled with the uncertainty, and someone's put in about new homes bonus as well, some of the uncertainty, it's all about the uncertainty that makes this really tricky, but especially the big gap that we could potentially lose on business rates.
Yeah, I know what you mean, and I think Stuart made that point about financial resilience almost being. I wonder whether that might be one of the primary lens potentially that ministers have to look at this. And I think for you, I mean, you're in Swale and in North Kent, with all that growth that you've got there, and others. I mean, I know Clive Mason in Harborough, plenty of growth. Lots of you on the call with lots and lots of growth, especially districts very reliant on that now. And I can't see them not resetting the baselines, because there's such a lot of money now tied up with those baselines, 1.5, 1.6 billion, something like that. But equally, I can't see that not being part of the transitional package. I know that we've not seen anything specific on that, but I just can't see that not being part of that support package. Stuart, I don't know what you think about that.
But what kind of level? That's the thing, because if it's such big numbers that even like £1 million loss to us would be huge.
Yeah.
So I mean, please be assured that for an authority that's small, it certainly doesn't disappear off the radar. It's the numbers are significant for you, just as they are for larger authorities. None of this is settled. No decisions have been taken, but I think it is likely that transition will operate across quite a broad field, maybe even including new homes bonus. Who knows? Somebody asked about news on that. Well, there isn't any. It's likely just to continue to roll forward as a sort of 1 year post incentive. But there is a question for ministers where they want to continue with that. They want to free up that money and stick it into the general allocation pot in some way. I mean, all of this just demonstrates how difficult this is. And as Adrian said, I forgot to mention, but of course, for each year that happens in which you have an approach to the settlement which is different from your favoured model of reform, for each year that happens, you move further away from where you want to be. So your task becomes more difficult. So just as a specific, some authorities are accumulating business rates growth every year, so for them, as one of our colleagues just mentioned, the reset becomes more and more serious. And it's very difficult for you with members to say, oh, this might get taken away at some point, because perhaps you've cried wolf before. And so for members to somehow set that aside from the pressing needs of services in the budget setting process is very, very difficult for you and for them. So, this is in reality funding critical services at the moment, and but the kind of the logic of the system and the imperative of needs that are underfunded in other areas suggests that there needs to be some redistribution, and those were the commitments that are made by successive ministers over time.
Yeah. And exactly. I mean, for some people, for 5 years running now, they've been telling their members that the baseline reset is imminent. It's going to happen any day. It's hard to keep that one going. Dan, were you going to say something?
Yeah, it's just another question for Stuart, really. You both mentioned resource equalisation probably not favouring more well-to-do areas, and the needs assessment favouring more deprived areas, as that's reinstated. But there's a couple of areas. When I look at debt gearing, for instance, the Mets and some of the London authorities have very, very high debt gearing, but it's from the old regime, pre-Prudential. But am I right in thinking, Stuart, that so previously in the old system, the government said effectively, yeah, go ahead and do this, and we will. The capital financing RNF would effectively service that debt or provide a contribution towards servicing that debt. But that's been rolled into SFA, hasn't it, and then cut fairly bluntly. So I can see that the differential in debt gearing, some of it is historic, some of it's legacy, and it feels like it's a bit unfair on those areas that had high legacy capital, given that they still have the borrowing that underpins that. The government allowed them to get, but they haven't got the financing. And I guess similar to that is council tax support, where 10% was cut off the council tax benefit bill, and then council tax support was provided in lieu of tax-based changes. I see massive differences in tax base after council tax support. But again, that's been cut because that got rolled in as well, hasn't it? So it feels like there's two more factors that I can see that might get unwound in any subsequent fair funding review.
So if I've understood that correctly, I think you're right. The legacy capital finance part of the system relates to the pre-prudential borrowing period. So it's the kind of related to the amount of debt that was outstanding at that time, reduced by an assumption over time. And there are choices in the new system about whether you fund that in full or in part. I think it's not funded in full in the current system, as you say, because the level of support has been cut, but there is a choice about whether you fund it in full in any future system. And obviously, if you don't, then that's, you know, a bit like resources equalisation is an area that will disbenefit or benefit certain authorities. The assumption about the debt for the prudential period is that that's met within the resources that are available. That's kind of central to the whole system. So this is entirely about the legacy debt.
Thank you.
Lisa, you're coming back. Another question.
I have got a different kind of question, if that's all right.
Yeah,
no one else has got their hand up.
Yeah, that's great.
It's about funding in general, and the waste reform stuff, the narrative around the ERP funding that we are going to get. I mean, this scares the life out of me, to be honest, because the meeting that we had when Section 151s were finally invited to meet with DEFRA, and I keep calling you MHCLG, that's a habit I can't get out of at the moment. But
I thought it referred to ODPM, so there we are.
And you know, we were invited to the table quite late on that, and it was quite. The meeting went hostile quite quickly, I think, when we raised concerns, and I'm now hearing narratives through the district treasurers and things that, you know, that they weren't happy with how we reacted. But I just think it's a total misunderstanding of how, you know, difficult this is for us. And I think the question was directly asked about second-tier authorities, and DEFRA came back with, oh yeah, we haven't really thought about those yet. It was like, really? Well, like, there's more of us than there is of anyone else. But the narrative seems to be that this is new money and that we should be grateful and accept it. We don't know what strings are attached to it. And in isolation, it may well be new money, but without answers on new homes bonus and any other resets, I think, I mean, I'm never that optimistic about things like this anyway, but it just seems that we are clashing with central government over what they think they're doing us a favour, and we think that it's, you know, we need to know more about it. And I wonder what anyone else thinks about it, or whether I'm just overreacting and it will all be fine.
I mean, there's something I need to find out a bit more. I've been sort of putting feelers out to try and find out what's going on there. I mean, I think one of the things it said in the settlement last year was that, or the policy statement before the settlement was that will be taken into account in the 24-25 settlement. I mean, to my mind, and I don't know what you think about this, Stuart, that seems really quite tricky. I mean, income isn't routinely taken into account in a settlement, and doing that kind of tricky stuff as something's being implemented seems really quite, I think it's challenging. I think it'd be difficult to do, but it doesn't mean to say it won't happen. I mean, Stuart, what do you think?
So this is both a little bit outside my area and also after I left, but my general thoughts would be, I think you're right that this is a potentially complicated and significant area. I don't and never did fully understand the rationale behind it. Ironically, in another job, I was responsible for the original wave of producer responsibility reforms, and the idea behind those is they would raise money in order to promote additional activity to improve the level of recovery and recycling in the economy. And so I take the point as a challenge, you know, is this really free money? And ought it to be free money? Because if you're expected to do more, then surely you need extra resources beyond what you've got at the moment to do that. But government seems to have a sense that there's an additional slug of money coming. It's unhypothecated, and therefore it needs to be netted off. The other point, I'd go back to what I said earlier about significant changes which can have a profound effect for authority should be well prepared and consulted on in advance. I'm not sure if you pick up any sense of that from DEFRA or DULUC. I would not go straight into the provisional settlement with a significant adjustment of this nature that you haven't seen before. That's quite high risk, I think.
It feels like they're busking it, doesn't it, in a way, to be honest.
And I think also that the methodology behind what we're going to get allocated, however we're going to get allocated, is not based on actual spend. It's based on what they deem an efficient service should look like. And with someone, we've just gone out for re-tender for a new contract, which isn't due until next year. So our current costs are nowhere near what our new procurement costs are going to be anyway. And so if they don't think we're efficient as we stand now, wait till they see what we're actually going to be paying in a couple of years' time. And so we're, you know, even if we are going to be compensated, it's going to be nowhere near what we're actually having to pay.
That's good. Yeah. Dan, what were you going to say?
Yeah, I have an additional concern with what Lisa said there, and that if you look at the last year's settlement, this is for districts particularly, districts have lost out in the last couple of years hugely by a new EMS bonus going from 6 to 4 to 2 to 1 year. And that's been replaced first by lower tier services grants and lastly by the funding guarantee. But there is an absolute equal relationship between those, in as much as when those that lost new EMS bonus and LTSG last year got an equal replacement in funding guarantee, it was a pound for pound thing. My issue is that when this extra money comes in, is that'll just allow all the transitional funding guarantees to disappear. So you'll get this extra production responsibility money, but you'll lose the funding guarantee. And in one sort of deft flip, the government will have removed all the transition grant, which, let's face it, social care I think will be a big pressure, and you will get more money, but all the transition grant will have disappeared. So net wise, it'll still say you've had a 3% increase. We guarantee everybody that, but what they've done is diverted all the new EMS bonus savings elsewhere and filled the hole with this. So it won't be absolutely new money. Some of it will go to replace what I think will be transition grants that have disappeared.
That is my point exactly. That we can't look at it in isolation. It's got to be taken into account with all the other pots that we currently get, but at the moment the narrative is be grateful this is new money, but we can't bank on it as new money. I can't budget for it as new money.
No. And if you look, I don't know if it did one of the previous sessions there is this straight line graph between funding guarantee and loss in NHB and LTSG. And the big thing that I'm not sure it was intended by the government, but if you never got new EMS bonus and you therefore probably didn't get much lower tier services grant, you don't get any funding guarantee. So the funding guarantee doesn't benefit those who've never had the reward money in the past. It benefits those who've had it. So it continues rewarding people. So it's a really bizarre setup as far as I can see.
Yes, complexity.
And apologies, I called it ERP and it's EPR.
EPR, yeah, with a small e. Yeah, I'm wondering about, I've been a bit blasé about it just because I didn't think it was going to happen, because I thought it was too complicated. I think maybe need to do a bit more work on that. I know I did email Nicola Morton the other week, and she said it was too complicated to put in an email. We'd have to talk about it. So maybe that's a conversation that we need to have about that. Yeah. Any more thoughts from anybody? Dan, I thought that chart of yours was really interesting, actually. That the one where you had the dotted line and the solid line, showing even on an adjusted basis that reserves have been going up, but are just now started to turn around and started to reduce again.
Yeah, and I think what we will get to eventually is they're coming down, but in some authorities they're coming down drastically. And I always, in our modelling, we use Northamptonshire, Croydon and Slough, and that direction of travel, which was pretty significant. I argue you could have picked off their problems 3 or 4 years before they did by looking at that direction of travel. But you can see some direction of travels there, and I think you will all know better than me that you will have intended to use reserves last year because the funding, the austerity years are really starting to bite, but you will have also had a lot of unintended use as inflation, interest rates, etc. started to hit, as well as pressures. What I'd worry about is that although 23-24 wasn't a bad year, it was only in a sort of real terms treading water, wasn't it? We got back 9% increases, but inflation's at 9%. Those pressures continue to increase, and there really isn't any additional funding. Then the reserves will continue on that spiral, and some that are starting to top out will turn and start to go down. But those that are already rapidly decreasing feels like they've got potentially massive structural issues. And some of them have got a year or two at the run rate of depletion where they'll run out. So that's where I think, without trying to be over sensationalist, there's some real issues stored up on the balance sheet for some authorities. So it'll be interesting to, when more accounts come out, to see if that pattern continues across the board.
Yeah, and understanding, I think it's probably almost impossible, but having more understanding about what's behind those reserves numbers and what that means for financial resilience, financial strength or weakness for different types of authority or different individual authorities, I think that is important, I think, for any kind of funding reform. I mean, you said about the counties, for instance, and about how some reserves have been going up faster than the average for counties. They've been replenishing more in recent years on average. For some of those counties, Surrey, in our modelling, they could lose such a huge amount that even though on paper, a big county looks fairly resilient at this point, big losses in funding over the next sort of 5-6 years, that makes a big difference. That's an outlier, I think, that is important, and you can't just say, well, the numbers say it needs to be reduced by X amount. At that point, that authority just becomes difficult to manage financially, becomes unviable. That's tricky, I think.
Yeah, and I think, to be a bit more balanced, counties have increased or they haven't dropped like the others, but they're coming from a position where their reserves were always much lower than the other tiers, and that again starts to feel like it's an interesting argument about the fairness or unfairness of the funding. You could absolutely say that it's been tougher on deprived authorities, but from a position where it was probably under the previous Labour government, it's probably quite generous. So it's getting that balance, isn't it? But there's definitely signs that counties' reserves have been more resilient, but from a position where they had the lowest. So it's not as simple as saying, well, they're okay now, because they've only recovered to a sort of level that the other types of authority are starting to come down to. But without some, I would say, without some fair funding intervention, counties will continue to be more resilient as the others become less resilient, because in all the other tiers of authority, with the exception of districts, reserves are now starting to come down at quite worrying rates, I'd say.
Yeah. Any other? We're pretty much on half 11 now. Just want to make sure we finish on time. Any other thoughts or questions before we sign off? I think we've done a pretty thorough job of that. Thanks to you, Stuart, for that. It was really interesting, you taking us through that and letting us see it. I know you don't want to give it, you can't give things away, but they're really good insights into what happened and how ministers of any type would look at things, the lenses they look through, and all that kind of thing. That's really useful for me, and I hope for everyone else on the call as well.
It's not necessarily a job that any of us would relish, to come in and have to look at this system after the next election, no matter what set of ministers we have.
Yeah. I mean, it'd be great if, as a sector, we could come together and say this is how it ought to work. Personally, I think there were quite a lot of principles that we could agree on, but the outcomes are always more political than technical in the end. So, yeah, not that easy. One final thing, someone mentioned that on the 28th of June, that's the Public Finance Live. Is that the tip for conferences that day? So I'll have a think about whether the 28th of June is still the right day. I think it probably is. I think we'll go ahead on the 28th of June with that MTFP webinar, and just make sure it's recorded. And if you need to look at it, it's there to look at. But we'll have a think about that over the next day or so, and let you know which way we've gone. Thanks, Stuart. Thanks, Dan. That was great. Remember, Dan's webinars next week, so sign up for that and go and have a look at what's going on there. I'll be there, and I'll see you there, hopefully. Thanks, Stuart. Thanks, Dan. Thanks all.
Bye, everyone. Thank you.
Cheers.
Thank you. Bye now. Bye-bye.